after a strong report in the U.S. services sector triggered another round of selling in the bond market. So as rates continue to climb, how can you protect your portfolio and prepare for even higher rates? Joining me now is Jeff Reeves, InvestorPlace.com editor. Jeff, we need this advice now more than ever. First of all, how high do you think rates are going to go?
Well, I mean, it depends, because right now the Fed funds rate is effectively zero, but rates are going up higher anyway. So, I mean, it's an interesting little give and take that we have here, where the Fed, I think, wants to project this idea of economic growth and stability, and hopefully things are going to be good. But, I mean, the market's acting differently. So if you're asking about the 10-year, I mean, right now things are at 3. They could considerably go higher, even without, without any move from the Fed.
Has the Fed lost control of the rates? That is, are they going up on their own, or are they going up right now because they suspect we're going to have a good jobs numbers? They'll start tapering. They're trying to get ahead of the Fed tapering.
Well, yeah, I think that's it. And that raises an interesting question, is whether or not rates are going up because they should or not. And I mean, right now we've seen a bunch of data that's slightly encouraging, so investors are thinking that rates are going to rise. But it's an interesting give and take here, because if the Fed decides that it doesn't want to actually tighten up policy, well, then you kind of have the market saying one thing and the Fed saying another, which is a dangerous position, because if the Fed is saying that things aren't that great out there, maybe the market corrects. Or if the Fed says, no, rates shouldn't go up, but they do anyway, then what? Then we have an ineffective central bank. I mean, either scenario isn't very good.
We're looking at the chart right now. I mean, that is a scary chart when you look. I mean, obviously 3% is not a scary number, but you look at the increase, the rate of increase, that's a doubling. If it doubles again by December, we're up to 6%. So we're going to have higher rates one way or the other. They may not be 6%, but they're going to be higher. How do you prepare for those higher rates right now if you're an investor?
Well, number one is if you own bonds to duration right now, like you're an income investor and you just, you pay to own a bond and then get your interest from it, that's fine. It's not going anywhere. It's like a mortgage on your house. Once you fix the interest, it's set. But if you're in a bond fund, like many people are, you got to remember that they keep rolling, especially these long duration funds. If you look at the chart from May to July, when the rates on the 10-year went from like 2% to roughly 3%, the TLT, a widely traded ETF, lost 1% or lost 15% in that period, when rates went up only 1%. So if you're only getting maybe 3%, 4% income returns, but your capital disappears 15% as rates go up, well, then you need to protect yourself. And it's important to remember that in a bond fund that they are trading these. They're moving out of those over time. And you run the risk of losing capital. Even if your income doesn't change, the actual capital you have invested in bonds, it's that whole inverse relationship.
Hold on to the bonds you have that are giving you the dividends. What about buying new bonds? Obviously, you stay away from long-term bonds. I mean, that's a given because of what's happening to rates right now. But do you buy into short-term bonds?
Well, yeah, I mean, there's always a trade-off. You have to remember your portfolio is a mix, so I would never advocate moving everything into short-term bonds, especially if you're into income, because the yields aren't as big. But you do kind of protect yourself against the loss of capital as rates go up. So you maybe want to rotate part of your portfolio into shorter duration bonds. The income isn't as good, but you won't take a hit once rates rise on the capital that you would otherwise.
How short? Are you talking? We're looking now at 1 to 3 year treasuries. Is that a time frame you're looking at now?
Well, it depends on how much you think rates are going to rise and how much you can give up on the income. I mean, if you're in 1 to 3 year treasuries, then even if rates go up, you're going to tread water. You're not going to take a hit at all. So that's good from a capital perspective. But if you're living off that income, you can't afford to make 1% or less off of your bonds. So again, it's a balancing act depending on what you want to do, your risk versus loss of capital or loss of income with your dividends.
Now, you want to diversify. You always want to diversify. And you say you don't want, obviously, all bonds. But you do want, there are some stocks that kind of act like bonds, right?
Yeah, that's right. Like a diversified portfolio for income, I think that now is a decent time to consider kind of dividend-like stocks that throw off some income via yield.
For example?
Again, there's risk. Well, for example, you want to look at stocks, some of the big telecoms, utilities, consumer staple stocks. Again, things aren't so grand right now in the stock market. You do risk the loss of capital. But again, if you're going to lose capital in long-duration bonds, I mean, the devil that you know may be better than the devil you don't know. I don't know. You need to think about this as an investor based on your own personal investing goals. But there is income out there beyond just bonds if you're looking for a short solution. And I would also caution people, these are not the fixes that you make for the next 10 years. Like if rates do change over the next 12 months, you can always reassess. Remember, even if you are a buy and hold investor, it behooves you to do some maintenance on your portfolio at times like this.
Okay, and some people, as you know, are chasing yields, and they'll go to junk bonds in order to do that. You say no way, don't touch them, right?
Well, I'm a little worried about junk bonds just because in a higher rate environment, I mean, think about the kind of tough companies that are out there that are, if you have $100 million in debt at 6 or 7%, that's pretty hard to make those debt service payments. What if that service gets to be like 12%? You know, I mean, that's much harder to make, and the default rates are going to go a lot higher. So I think people fell in love with junk bonds because, you know, it's not like a 6% debt service payment was easy to make, but it's a lot harder to make a higher payment once rates rise. And people need to remember that about junk, that as the rates go up, the burden on the companies that are embattled, that's why they have to pay high yield, remember, is because they can't get a lower rate on their borrowing. So it's going to become even harder for them to achieve that kind of, you know, balance between on-the-bubble financing that they're going to need to keep the lights on and then still be able to meet their debt service payments.
Well,